As of the close of normal trading on Friday, May 29, 2026 at 4 p.m. Eastern Time, Navitas Semiconductor trades at exactly $26.60 per share, marking a significant intraday decline of 6.7% on a heavy trading volume of over 23 million shares. The stock experienced volatile swings throughout the session, opening at $28.75, hitting an intraday peak of $28.80 and sinking to a low of $26.08. This sharp pullback catches many market participants off guard, especially given the recent bullish run that pushed the stock past its prior milestones. While the headline numbers show a painful daily drop, the underlying mechanics of this trading session point to something much larger than standard retail panic. Institutional blocks were actively adjusting their risk exposure, creating localized liquidity traps that forced stop-loss liquidations across multiple retail trading applications. If you check hot trading channels or read through standard market commentary, you will find people complaining about general tech weakness, but the reality is an aggressive rotation out of legacy components and into highly specialized power electronics. Smart market participants are realizing that standard silicon cannot keep up with the extreme energy requirements of modern computing clusters. This intraday sell-off is a direct reflection of structural repositioning rather than a fundamental flaw in wide-band gap semiconductor adoption. The prevailing sentiment surrounding Navitas Semiconductor centers on its role as a high-risk, high-reward bet on the future of energy efficiency, with investors viewing it as a speculative vehicle to play infrastructure growth. The general consensus says that because the firm exited its legacy low-power mobile charger business, it left itself exposed to structural cash burn while waiting for data center contracts to scale. This viewpoint leads many to stick exclusively to giant large-cap names like Nvidia stock, assuming smaller component players are too volatile to touch. However, this common perspective misses a critical shift in capital allocation and technological design. The real story is that Navitas is systematically re-engineering its entire pipeline to capture high-voltage systems, meaning the revenue drop from abandoning mobile markets is a deliberate clearing of the decks to maximize long-term gross margins. To evaluate the setup properly, you have to look closely at the immediate trading data and recent institutional activity. The daily volume spike to 23.15 million shares indicates that large-cap funds are utilizing price dips to accumulate positions while retail traders panic sell on short-term technical breakdowns. Over the past few weeks, short interest in the semiconductor sector has climbed as macroeconomic pressures and high interest rates weigh on growth asset valuations. This short pressure frequently targets companies showing temporary net losses, hiding the massive sequential top-line growth underneath. When looking across popular digital brokerage accounts or executing order flows on the Interactive Brokers platform, the data shows retail accounts actively cutting losses, while specialized exchange-traded funds quietly rebalance their weightings to capture more exposure to gallium nitride and silicon carbide technologies. Understanding the broader investment landscape requires looking at how different platforms handle these high-growth microcaps. Investors utilizing comprehensive systems like Fidelity Brokerage or managing their wealth through Fidelity Investments often see a stark contrast between traditional technical indicators and long-term fundamental value. The broader market indexes have been experiencing major swings due to stubborn inflation metrics and shifting Federal Reserve policies, which disproportionately punishes equities that do not yet boast positive net earnings. Yet when you analyze institutional filings, you notice that specialized technology funds, including specific Fidelity ETFs and Fidelity mutual funds, have sustained their interest in alternative power materials. This suggests that the institutional layer of the market is operating on a multi-year horizon, completely detached from the daily retail sentiment shifts observed on platforms like the Robinhood app. When we break down the latest corporate financials, the tension between expectations and reality becomes incredibly vivid. In its first quarter report for 26, Navitas delivered a revenue figure of $8.6 million, which actually beat consensus expectations of $8.18 million, marking an 18% sequential growth over the previous quarter. However, the market ran into a wall of reality when the company posted an earnings per share loss of 15 cents, missing the forecasted loss of 5 cents by a wide margin. This bottom-line disconnect is exactly what caused wild price swings over the last few weeks, causing the stock to skyrocket initially on the revenue beat and AI infrastructure growth before settling into the volatile pattern we see today. The core issue is that while the high-power business grew 25% year-over-year, the operational expenses involved in retooling production facilities for next-generation products are temporarily eating up capital. This structural transition is where the company's core business model comes into play. Founded as a pioneer in next-generation power semiconductors, Navitas specializes in proprietary gallium nitride and silicon carbide technologies, marketed under brands like GaNFast and GaNSafe. Unlike traditional silicon chips, which waste a massive amount of energy as heat when stepping down high-voltage electricity, gallium nitride allows electrical systems to operate at much higher frequencies and temperatures, while shrinking the physical size of the components. The business model previously relied heavily on supplying chips for high-end mobile phone fast chargers. However, management realized that the consumer electronics market is a low-margin commodity trap, prompting a strategic pivot toward enterprise data centers, electric vehicles, solar inverters, and heavy industrial grid infrastructure. Comment below how many shares of Navitas Semiconductor you currently hold, or if you prefer sticking to larger component names. Looking at the older reports and past performance, Navitas historically struggled with scaling its operational footprint, often running into production bottlenecks because it operates on a fabless manufacturing model. This means it designs the intellectual property and relies on external silicon foundries to physically print the wafers. In 24 and 25, this model exposed the company to severe supply chain disruptions and margin degradation whenever foundry prices fluctuated. Cash burn was a persistent issue, leading to frequent capital raises that diluted early equity holders. However, the balance sheet now shows a cash and cash equivalents position of $221 million, with no outstanding debt, providing a substantial runway to fund the current transition without forcing the company into predatory lending markets or toxic debt structures. The operational reality going forward hinges completely on customer validation timelines. Management has guided for second quarter revenue to reach $10 million plus or minus $500,000, with non-GAAP gross margins expanding slightly to 39.25%. This outlook assumes that mobile phone revenue will diminish to an insignificant level by the end of the calendar year, leaving the revenue mix entirely dependent on high power sectors. For an investor executing trades via SoFi Invest or setting up long-term automation through Schwab Intelligent Portfolios, evaluating this guidance requires looking past the simple price-to-earnings ratio, which remains negative, and focusing instead on system-level design wins. The company recently introduced a 10-kilowatt direct current platform specifically designed for artificial intelligence servers, which is currently undergoing rigorous system validation by multiple global server manufacturers. The future outlook for Navitas Semiconductor presents two distinct scenarios dictated by the ongoing tension between market narrative and corporate execution. In the bullish scenario, the massive capital expenditure wave hitting global data centers turns into a multi-year tailwind. As hyperscalers pack more graphics processing units into tightly enclosed server racks, traditional cooling and power delivery systems fail, making the adoption of high-efficiency gallium nitride chips an absolute operational necessity rather than an optional upgrade. If Navitas successfully converts its current customer trials into high-volume production contracts by the end of the year, revenue could rapidly scale past the $41 million mark projected for the full year, pushing the firm toward operational profitability ahead of analyst expectations. This would trigger a massive short squeeze as institutional funds scramble to build core positions. Conversely, the bearish scenario cannot be overlooked by anyone engaged in online investing or individual brokerage management. The primary risk lies in the extended validation cycles typical of enterprise and industrial customers. Unlike consumer electronics companies that approve designs in a matter of weeks, data center operators and automotive manufacturers often demand 12 to 18 months of continuous component testing before placing large production orders. If these validation cycles drag out longer than anticipated, or if larger competitors with deeper pockets launch matching silicon carbide solutions, Navitas could see its revenue growth stall while its fixed operational expenses remain sticky at $15 million per quarter. This would deplete its cash reserves and force another round of diluted financing, damaging retail sentiment on platforms like SoFi Active Investing and dragging the stock back down toward its cyclical lows. To navigate this asset successfully, you must maintain a clear view of how expectations contrast with reality. The market expects immediate, explosive revenue growth to match the broader AI narrative, but the reality is a methodical, slow-moving hardware qualification process that requires patience. Investors looking for a stable, slow-moving investment might find shelter in managed structures like a robo-advisor or automated investing sites, but those choosing self-investing must be prepared to stomach intense intraday volatility. The structural drop observed in the latest trading session emphasizes that this is not a stock to buy and forget. It requires continuous monitoring of macroeconomic shifts, sector momentum, and microelectronic design cycles. In summary, Navitas Semiconductor represents a pure architectural bet on the reorganization of global power grids and server infrastructure. The recent intraday drop to $26.60 highlights the vulnerability of growth equities in an uncertain macro climate, especially when a wide gap exists between high-power revenue expansion and bottom-line profitability. While the general public remains focused on the near-term earnings miss, the structural reality reveals a clean balance sheet, rising sequential revenue, and a deliberate exit from low-margin consumer electronics. Ultimately, the company's trajectory will be decided by whether its high-voltage designs can achieve widespread enterprise validation before its current cash cushion erodes, making it an essential case study in balancing market narrative against cold operational metrics. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.